Is tail risk hedging for short-term or long-term trading? Have you ever wondered how investors prepare for those unexpected market downturns? Today, we are going to discuss tail risk hedging and whether it is suited for short-term or long-term trading. Tail risk hedging is primarily a long-term strategy. It focuses on protecting portfolios from rare but severe market drops, often referred to as tail events. These events occur infrequently but can lead to significant losses. To understand why tail risk hedging is generally a long-term approach, let's look at the nature of tail risks. These risks are extreme and low probability events that can happen every few years or even less frequently. Because they are unpredictable, hedging against them is more about safeguarding your portfolio over a longer period rather than trying to time short-term market moves. Another important factor is the cost of hedging. When you buy out of the money put options or invest in tail risk exchange-traded funds, you usually incur ongoing costs. During normal market conditions, these hedges may not perform well and can even drag down short-term returns. However, they provide protection over the long run by limiting catastrophic losses. Long-term investors often use tail risk hedging to maintain portfolio stability. By accepting some short-term costs, they aim to improve their long-term risk-adjusted returns. This strategy helps avoid large drawdowns that could take years to recover from. In the context of options trading, using long put options or put spreads as tail risk hedges fits well with longer-term strategies. These options are typically held as insurance rather than for speculative short-term trades. They are designed to pay off during rare market shocks, making them a suitable choice for long-term investors. While tail risk hedging does requiring ongoing monitoring and occasional adjustments, it is not about frequent trading. Instead, it focuses on maintaining a protective position that responds to changing market volatility and risk levels. On the other hand, short-term trading usually aims to capture price movements within days or weeks. This approach does not typically incorporate tail risk hedging because the costs and timing do not align with short-term profit goals. In summary, tail risk hedging is best suited for long-term trading and investing strategies. It protects against rare but severe market downturns, accepting short-term costs for long-term portfolio durability and risk reduction. This aligns with advanced options trading concepts, where options on indexes or other derivatives serve as insurance tools rather than short-term speculative instruments.